Can I get a hello? Hey, all right, we're awake. Fantastic. Well, we got a great panel for you today. This is next-gen blockchain infrastructure. And we have three legends up here. I'm going to have them introduce themselves shortly. But to introduce myself, I am Alonzo, or Epoch Pool, founder of Epoch Pool and Cardano over Coffee. And I'm going to tell you a little bit about what we're talking about today. We're going to have FP Block, Anastasia Labs, and Maestro. And we're going to be exploring the frontier of Web3 usability, multi-wallet friction to gasless transactions, AI. Well, we're going to skip AI today because there's too much to talk about DeFi on Bitcoin. We're going to focus a lot on that. And let's get into the weeds, gentlemen. Who wants to introduce first?
I'm Wes Crook, CEO of FP Block. We used to be known as FP Complete. We were the original auditors of Cardano. We audited Hedera for 7 years. But primarily, we were builders, building dApps. We built many blockchains, about 115 projects under our belt in the last 10 years.
Fantastic. Phil?
Yep, my name is DiSarro. I'm the CEO of Anastasia Labs. We're an R&D firm on Cardano. At this point, we've developed or audited basically every major dApp on the protocol, and we're building Midgard, which is an optimistic rollup for Cardano.
Hey, my name is Varderes. I'm the co-founder and CTO of Maestro. We are a middle layer infrastructure provider for Bitcoin, and we want to enable global adoption of Bitcoin as the base of the financial economy, and Cardano as one of the execution layers on top of that layer. So I've worked with Philip pretty closely on the Cardano side, and it's really great to be here with the panel here today.
Awesome, awesome. So the first thing we're going to talk about is UX and wallet friction in the space. We all know that multi-wallet headaches are very real. You've got a lot to manage. What are your teams doing to smooth the onboarding process and reduce friction for those users that have lots of wallets?
Yeah, we actually have thought about this very deeply because a lot of our users are wallets, and there's two sides to making a successful wallet, right? You have the distribution of it, the marketing of it. It's very competitive. Lots of very talented teams are building wallets. And then you have the infrastructure and the data of wallets. And so we designed APIs to cater specifically to wallets and other types of APIs to make wallets very snappy and responsive. We noticed that there are patterns in what makes a successful wallet, and that a lot of the infrastructural problems of wallets are solved. It's now a matter of getting it out there and enabling the vast majority of people to actually be able to use them in a meaningful way.
Anyone else?
Yeah, I mean, yeah, so a lot of what we do is auditing and security, and one of the things we realized very early on is that retail users typically don't know whether an application on the blockchain that they're using is audited or not, and what level of security that application has. So one of the things we've done is work with IOG to create this secure upgrade mechanism, SIP, which is a Cardano improvement proposal that makes it such that when you interact with an application on Cardano, your wallet knows what level of auditing that application has been subject to, or whether it's been audited at all. And this makes security user-facing, right? So if you interact with a decentralized application that has not been audited, you'll get a big red pop-up that says, you know, this application has not been audited, use at your own risk, right? And on the other hand, if you interact with an application that has gone through extensive auditing and invested a lot of money into security, that will be reflected to you, and it will say, you know, this has been audited 3 times, it has formal verification, etc.
Awesome. One more question in this section. Gasless UX. Can I see a poll from the audience real quick? Raise your hand if you've heard of the term gasless. Gasless transactions, gasless anything. That's pretty significant. So the question here is it a gimmick, or is it actually the silver bullet for adoption?
I think it's a silver bullet for adoption. What we're doing at FP Block is we just came out with a new framework called Column, where your application is the chain. So you have no gas fees, you have no congestion, and then you can bridge out to the other chains, and they're all supported. So we believe that, as an application builder or dApp builder out there, you want to control what you're controlling and not be dependent on the idiosyncrasies of all the other chains. and having to pay fees during the development time and things of that nature. So being able to have a chain that doesn't cost you anything and you control is absolutely where we have to be to get this to move forward.
Sounds good to me. I definitely don't want to pay any extra fees that I don't have to. And I think most users would agree. So, part of making this ecosystem exciting is Bitcoin, right? And integrating it into DeFi platforms, throughout the crypto world. So what does it mean to put Bitcoin to work in today's DeFi stack? Who wants to take this one?
Yeah, so right now, Bitcoiners desperately are looking for safe yield. The key things that they want are to retain ownership of their Bitcoin, to retain the security of the Bitcoin network, and to not be at risk of receiving a different asset. So they want to earn yield in Bitcoin or stablecoins. And right now, the sort of standard for how you achieve this is a protocol like Babylon, right? And the APY is significantly low compared to the rest of the DeFi market. So you're looking at often less than 1% per year, and there's billions of dollars of Bitcoin locked into Babylon. So even less than 1% yield is very appealing to Bitcoiners, right? So what we're trying to do with this Bitcoin DeFi narrative is provide yield comparable with the rest of the market, at least 4 to 8% on just holding Bitcoin. And you do this by having liquid staking protocols where you have people lock up Bitcoin and then use it in voting systems similar to Babylon. And then, of course, users pay for that service.
Yeah, from a developer perspective, we are working on several projects right now. One called Sailor Lend, which is basically allowing you to use your BTC to lend out within the NEAR protocol and stake it and maintain your asset. So there's several projects under development from our side that we're doing that with, where Bitcoin is the backed asset, and we're also looking at some real world assets with gold and diamonds and things like that. But at the end of the day, we're using BTC as the collateral for lending, and we're seeing that become more and more prevalent.
So I guess what are the biggest trade-offs in doing something like that, right? You're bringing Bitcoin into a whole host of possibly other chains. There may be risks there. Can we talk a little bit about the trade-offs that users are going to have to go through if they're trying to utilize their Bitcoin?
I have a very different view of this. From Bitcoin and all the tokens and all the chains out there, I think we're in a period of consolidation. And I think we're in a period where the tokens are going to become less and less and less. We're going to get to a few standard tokens like Bitcoin as a standard currency for this space. And I think you'll see in the next 5 years, what we see today will probably not be what the world is.
Yeah.
Yeah, actually there's a lot to say about this, right? So Bitcoin meta protocols came into the scene about 2 years ago. So ordinals, runes, and now alkanes. And so that unlocked a lot of functionality on Bitcoin because people figured out creative ways to pack smart activity or smart contract-like activity into the Bitcoin transaction itself. So it created kind of a boom in Bitcoin DeFi or Bitcoin Fi, as they call it. So I think a lot of that's still being explored, but they showed what was possible. I personally believe that the Alkane's meta protocol is kind of the end game and will be the one that really brings DeFi to Bitcoin. But there is definitely risk in that because Bitcoin is not Turing complete, it has limitations on functionality, you have to trust indexers, right? So indexers are responsible for telling the ecosystem, here are the meta protocol transactions, here's what's valid, here's what's invalid. And I think there's actually an interesting use case where you can start to think about building decentralized indexers that have their own consensus. And I think that risk is still there. But yeah, I would say from our perspective, we ask that a lot of our users trust our indexers, and we don't really want to ask them to trust our indexers.
So building off of that, how are y'all going to convince the Bitcoin maxis to adopt a specific L2 or a specific platform? How are you going to do that?
Well, there's been waves of Bitcoin L2s, and the first wave of L2s are basically require bridging or some kind of multi-sig. I think the current wave of L2s that are about to be released, namely Middle, Arch Network, are two that come to mind. What's interesting about them is that they're Bitcoin native. So you connect your Bitcoin wallet directly, and there is no bridging. So the transaction you use to engage on that L2 and the settlement on Bitcoin happens in the same Bitcoin block. So yes, there's some kind of bridging within that block, but there's no multi-block bridging. And I just use my Bitcoin wallet very simply. And I think these wave of L2s are really going to attract the Bitcoin maxis because of that reason. There's like top level maxi where they want their own the specific sats and UTXOs that they use to come back to them. I think we're not quite there yet, but I think this is a great stepping stone.
Okay, so maybe we can get into the first level of maxi and get them excited.
There are many levels to that. I mean,
I mean, two very important things are, one, you have to retain the exact same user flow. So it needs to work with wallets that Bitcoin users are using. It needs to work with the same transaction system that Bitcoin users are using, right? Like you see like EVM type Bitcoin L2s, and they really don't succeed in the market. So that's what we're talking about with these new wave, which is a little more appealing to native Bitcoiners because they don't have to engage with MetaMask or other infrastructure. It's just their normal user flow.
Yeah, I think that's a great point. Most people don't want to change their flow at all. They want more capabilities with the tools they're working with. So let's switch a little bit here and talk about institutional adoption, right? That's a big topic at this conference, different institutions and governments, and everyone's getting involved. But my understanding is that they don't care a lot about memes, right? There's no meme coin discussion, no cool NFTs. Well, maybe if it's an infrastructure play. But they really want efficiency and compliance, right? That's what institutions usually want. So what infrastructure and UX patterns are going to make Web3 palatable? Like, how are we going to make them comfortable in the Web3 world?
I think what they're looking for is a standardization. There's too many choices out there today between all the different ecosystems, and we want to be able to consolidate that down. What we've done with our products and our toys and our tools is allow the app builder to build a network and a system that they can trust and that they own, and then they can bridge into the other places. What they don't want to have is the insecurity that is inherent in these chains. There is a lot of trouble. Pick a chain, they'll go down, they'll get hacked, and we got to get that cleaned up. And by building your own chain that you can bridge into other ecosystems, that will allow you to bring the institutions in. Simplicity, security, and governance is what they're going to want to see from us, and we're not really there yet with the way we're operating as a Web3 industry.
Yeah, I mean, so in the Cardano ecosystem, we have this new partner chain, Midnight. I'm sure you guys have seen it around the conference. And that's sort of exactly what this is geared towards, right? To allow selective disclosure, which is what institutions want. Like, if you're Coinbase, you're interacting with the chain, but you often want to be able to disclose certain information, like, to a given user because it's their information that you're, in custody of, but you don't want other users to have access to that information. And I think that these types of selective disclosure systems are the future for institutional adoption. And yeah, to your point, Midgard, the layer 2 framework that we're building for Cardano, is aimed to allow people to design rollups with their own custom security profiles. And what this means is that an institution like Microsoft can come on and create a permissioned layer 2 with some level of access, right? And you already see this in the largest layer 2s, right? Base by Coinbase and Sonium, right, by Sony. These are sort of the most successful instances of institutional adoption, and it's because it gives them a level of permission that allows them to operate within their regulations and not be at risk for user data and other things, while also not really compromising the blockchain ethos. Because, like, for instance, in Sonium, right, if you have some sort of scam coin, the coin will exist on the network. They can't prevent that. But what they can do is sort of prevent it at the UX level, right? So users won't see it anywhere. It won't be like listed on any of the dApps or protocols in the ecosystem. It will just exist on the network. And then like you almost get no retail scams because the only way people can interact with these tokens is by being a developer and like interacting directly with the network.
Yeah, so one of our major pillars as a company this year is to work with institutions and bring them Bitcoin infrastructure. And we've been talking to asset managers, custodians, and people that basically are sitting on a bunch of Bitcoin and they want to earn yield in a secure and compliant way. So practically speaking, one thing that we need to build is integrations with custodians. So custodians are not able to interact with DeFi and earn that yield from DeFi protocols, or we're calling them vaults. But building those integrations is a key step in allowing institutions to use their custodial wallets to earn the yield on their Bitcoin holdings. Yeah.
Wes, did you have something to add?
Yeah, when you're talking institutional and enterprise level solutions, the challenge we have in this space today is you have to build the application for each chain. That's very expensive for large organizations. They want to build one application and have it go where they need to. So getting chain abstraction into the equation will allow them to be more comfortable to come in because they know they can invest their millions of dollars in building these enterprise systems that we don't really have in this space yet. When you start looking at the big banks and the big trading houses, they don't want to invest time and time again building the same applications and the same connections to the various systems. Giving them one chain that they are trustworthy and have the custodials in, that's what we got to get to with the business.
Right. So building on this, I'm curious for any lessons learned as if maybe you've worked with some conservative Web 2 native type clients. I'm not sure their prevalence in your markets, but is there anything you've learned from working with the more conservative companies?
Yeah, that they really like insurance. And I feel like this is a really big blocker for adoption in Web3, institutional adoption. When you're managing large amounts of capital, even these custodial solutions, right, and you want to gain access to yield for your clients, it's very hard to justify to your firm that you're going to put funds into a DeFi protocol because traditionally, right, when you're making investments, you're insured through the roof, right? So if there's some risk, something happens, you won't be the guy who gets, fired. You'll be able to file insurance claims and everything will work out and you'll be able to pay out clients. But in Web3, historically, this has been extremely difficult, and it's one of the biggest reasons they do not deploy capital in DeFi. And over the past 2 years, we've sort of seen this start to change as new Web3 insurance firms emerge and provide things like smart contract protocol insurance and coverage.
Yeah, I think a lot of the areas is clearing up the regulatory environment, understanding what countries, what industries will allow you to do things. We come from building enterprise systems. Our lineage was working with large financial institutions, large pharmas, and building high transaction-based systems that had to be highly secure. And this world they need to see that coming to this space. So as we grow, we need to get better security, better process, better adoption, better everything to get them to come in and deploy their capital to the markets.
Yeah, I think it's changed quite a bit actually because from a regulatory point of view, I mean the fact that Genius Bill got passed and it's not exactly covering everything about institutional DeFi, but at least it's laying the foundations for stablecoins, which a lot of institutions care a lot about stablecoins because of the on-ramp, off-ramp aspect of holding crypto. And so I think we're in a very different place. I actually helped lobby for Genius Act, so that was very exciting to see that signed by the president. But another thing is talking to institutions, they don't want to share liquidity with like in a pool where other people are providing liquidity and they don't know where that money's coming from. Like they don't want to work with dark money. So these like idea of like consortium institutional rollups is very interesting, where they still leverage the security of Bitcoin, but they have compliant vaults where every investor in that consortium is KYC'd and they know each other to some extent.
All right, well, you said rollups, so we have to move to the last section here, app chains and rollups. Can I get a poll real quick? Raise your hand if you've heard of an optimistic rollup. Wow. Raise your hand if you've heard of a ZK rollup. All right, we have a very active audience in DeFi, it seems. So I want to know why, in general, are ZK rollups the hot item right now? You know, feels like it's taken the stage over optimistic rollups. Not to trigger you, Phil, but do you have any thoughts?
Yeah, so I can speak on this. So ZK technology is very exciting. It provides a lot of features that you can't achieve with traditional tech stacks, and this allows stuff like selective disclosure, right? This is what Midnight is built on. But there was a narrative for a long time that ZK enables like extreme throughput, and it's the way we're going to scale everything, right? And that's where the hype into ZK-L2 started to come from. But very quickly, the market showed that that's a narrative that's sci-fi, right? Right now, current ZK proof systems are slow. ZK rollups are significantly slower, lower throughput, lower bandwidth, increased latency over optimistic equivalents, right? That's why Base and Optimism and Arbitrum are all the highest economic activity L2s, and the ZK L2s have to fight with different feature sets, right? Like some elements of privacy, or using ZK to avoid MEV, and sort of that's why, at least right now, we're going in the optimistic direction. And the nice thing about this is that in 5 to 10 years, when these ZK proof systems mature and get to a state where you don't have to rewrite your rollup every 6 months because someone invented a new ZK folding scheme, you can always switch over, right?
Awesome. So you're talking about app chains, right? What's going to make a dApp builder excited to deploy or work with a specific dApp platform? Like, if I'm a builder and I want to make one version of it, right? Where do I look to integrate my application across multiple chains?
Well, that's exactly what we're doing with Colme, is to give the application builder the choice. They build the application one time into the Colme framework, and then they can choose which chain to go to. Or they can bridge multiple chains. So like today we have some EVM, Solana, Near, Cosmos. We're about to go BNB, and we got Polygon that we've already bridged. So you can move between those ecosystems and not have to rewrite your contracts and rewrite your applications to support that. It's all native into the Colme system. So from a builder standpoint, you can fail fast. You can get your application built, you can get it out there. We're seeing, and we have proven, we just launched a gaming application Thursday, Six Sigma Sports. Original build was on top of Cosmos. Took them 1.5 years to build it. We just rewrote it in Colme and deployed it in 4 months, out the door, production.
Wow.
We just did another project for Eternity.io, moved them off of Polygon into Colme in 4 weeks into production. So what we're trying to do is let the builders build great applications and not have to worry about the infrastructure and picking chains that may be popular today but not tomorrow and have to rewrite.
Yeah, I think there's a lot of follow-up questions I could ask on that. These are very hard problems to solve in blockchain. But I want to thank you all for your time. I think this has been a great panel. Thank you, audience, as well, for participating. So we're going to get up and leave you, but there's another great session, so feel free to stick around. And thank you all for coming to Rare Evo. Let's go.
Enjoying Rare Evo? Then lock in your spot for next year right now. Rare Evo 2026 is already in the works, and it's going to be even bigger. More chains, more builders, more connections. Tickets are live. Go to rareevo.io/2026 to grab your early access pricing before it's gone. Don't wait. Be first. Be part of what's next. We'll see you at Rare Evo 2026.